Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that is a bit of a curveball, a real plot twist in the corporate world, where a deal that seemed set in stone might be hitting a snag. Get ready because we've got a story about a company, a merger, and a whole lot of uncertainty. Before we jump in, if you love getting the real story behind corporate filings, make sure you are subscribed. And if you want to connect with other business enthusiasts and get exclusive content, join our Discord community, linked in the description below. We're looking at a filing from Soho House & Company Incorporated, and it is an urgent report filed on the 5th of January 2026. This isn't your typical quarterly update telling us how great things are going. This is more like a red flag, a heads up that something significant is happening, and it is not entirely positive. Basically, the company is legally required to tell us what is going on, and they've chosen to use this specific form to share some important news about a deal that was supposed to happen. Soho House, for those who might not be super familiar, is a global hospitality brand known for its exclusive clubs and hotels. Think swanky spots where creatives and business folks gather. They're incorporated in Delaware, a common place for big companies to set up shop, and their stock is traded on the NYSE under the ticker symbol SHISHCO. Now, let's get to the heart of this filing. It is all about a merger agreement that Soho House entered into back on the 15th of August, 2025. This deal involved A Parent LLC, which is an affiliate of the Yucaipa Companies LLC, a well-known investment firm, and also a Merger Sub Incorporated, which is basically a shell company created by Parent to buy Soho House. The plan was for Merger Sub to merge with and into Soho House, making Soho House the company that continues to exist after the merger, but under new ownership. This merger was set up so that Parent would acquire Soho House. It was supposed to be a big deal, a significant change for the company and its shareholders. Here is where things get interesting. To help fund this acquisition, CR Hospitality Fund, a big investor, committed to put in $200 million. That is right, $200 million. This money was crucial for the deal to go through. It was meant to be used to partially pay the Soho House stockholders for their shares. Now for the bombshell. On the 5th of January 2026, Macchiar told Yucaipa that they wouldn't be able to provide the full $200 million at the time the deal was supposed to close. This is a major problem. When a key investor backing a merger can't come up with the funds, it throws the entire acquisition into question. The good news, if you can call it that, is that Yucaipa and a special committee on Soho House's board are not just giving up. They are actively talking to Macchiar and other potential investors to try and secure that $200 million. They're exploring all options to make sure the deal doesn't fall apart because of this funding issue. But, and this is a big, but there is no guarantee they will succeed. Despite this funding hiccup, Soho House is still moving forward with the next step, a special meeting for stockholders on the 9th of January 2026. This is where the shareholders will vote on whether to approve the merger agreement. It shows they're trying to keep some momentum going, hoping the funding issues can be resolved in time. The ultimate goal is still to close the merger as quickly as possible, but that now hinges on sorting out this $200 million funding gap. This section is all about making sure investors have access to all the official documents related to this merger. They've filed a proxy statement, which is a document sent to shareholders asking them to vote on the deal, and other important disclosures. They're basically saying, go read all the paperwork if you want the full detailed picture. They're really emphasizing here that investors need to do their homework, read all the filings, understand all the risks and details, because this merger is a big deal and there's a lot of information to digest. They want to make sure no one makes an investment decision without being fully informed. Just a technicality here, they're pointing out that the website addresses they mention aren't live links and the information on those sites isn't automatically part of this official report. This part informs us that the company's directors and top executives might be seen as participants in trying to get shareholders to vote for the merger. Basically, the people running the company have an interest in this deal going through, which is pretty standard. They've already disclosed information about their stock holdings, and any changes will be updated with the SECs. This is a really important section in almost every SEC filing. It is a warning to investors. The company is talking about future possibilities, but they're making it very clear that these are just predictions, not guarantees. They use words like may, should, will likely, and anticipate to signal that these are potential outcomes, not certainties. They're saying that when they talk about what might happen in the future, it is based on their current best guesses and assumptions. It is crucial to understand that these are not facts about the past or present. They really hammer home the point that future predictions are not promises. There are a lot of risks and uncertainties involved, and the actual results could be very different from what they're expecting or hoping for. This is a standard legal disclaimer, but it is also a genuine warning that things can go wrong. They're directing us to other filings for more details on these risks. It's like they're saying, if you want to know exactly what could go wrong, go read these other reports. It suggests that the company is aware of potential problems and they've documented them. This is the legal way of saying, don't sue us if things don't turn out as we've predicted. They want to manage expectations and ensure everyone understands that the future is uncertain. And finally, they're stating that they don't plan to update these future-looking statements. So, the information you get here is what it is, and they're not committing to keeping it current if new information comes to light. And here we have the signatures, the official sign off on this report. We see the signature of Neil Thompson, who is the Chief Financial Officer. This means he is officially confirming the accuracy of the information presented in this filing. The date of the signature is the 8th of January 2026, a few days after the filing itself. So what is the big picture here? Soho House was set to be acquired with a significant chunk of funding coming from MECR, but MECR is now signaling they can't deliver the full amount. This puts the entire merger in jeopardy. The company and the buyer are scrambling to find the money, talking to MCR and other parties, but there is no guarantee they'll succeed. Meanwhile, they're still pushing ahead with shareholder votes, hoping for the best. From a financial perspective, this filing isn't about profit and loss, it is about deal execution. The core of the story here is the uncertainty around the funding. The $200 million commitment was clearly a linchpin for the deal. Without it, the acquisition as originally planned is in serious doubt. This is a classic example of how a single funding issue can derail a major corporate transaction. What this means for Soho House shareholders is significant. If the deal falls through, the stock price could react negatively, as the expected premium from the acquisition would disappear. If they manage to secure the funding, it suggests that the buyer and the company are very committed to this transaction, despite the initial hurdle. The mention of engaging with other parties suggests they are actively seeking alternatives, which is a positive sign of proactive problem solving. But the lack of assurance is a clear warning. The real risk here is that the merger agreement collapses. If it does, Soho House will have to regroup. Potentially under less favourable market conditions, or with a damaged reputation after this public announcement. On the other hand, if they do manage to secure the funds, it could signal a strong belief in Soho House's future value from the investors, and the deal could still proceed, albeit with a delay. The company's strategy right now seems to be maintaining forward momentum by continuing with the shareholder meeting, while actively working behind the scenes to resolve the financial shortfall. Looking at this from a broader perspective, it highlights the inherent risks in large merger and acquisition deals, especially those involving significant investor commitments. Even with formal agreements, unforeseen circumstances can arise. The fact that MECR is unable to fund its commitment at this stage, right before the closing, is a significant red flag. It raises questions about MECR's own financial stability or their reassessment of the deal's viability. In conclusion, this filing is a clear warning sign for Soho House and its investors. The supposed acquisition is facing a major roadblock. While there is a stated effort to find a solution, the lack of certainty means the future of this deal is very much in doubt. It's a stark reminder that in the corporate world, deals are never truly done until the money is in the bank and the ink is dry. Alright, that is our deep dive into this latest filing from Soho House. What is your take on this situation? Do you think the deal will go through, or is it destined to fail? Let us know your thoughts in the comments below. If you found this analysis helpful, please hit that like button, it really helps us out. And don't forget to subscribe for more corporate breakdowns. And as always, check out the Discord link in the description for more great discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.